You just placed a market order for $10,000 of Bitcoin. Your brokerage shows a fee of $10, but the true cost of that trade was $23.33, not 10, 23. The extra $13 never appears on any receipt. Before we calculate the cost, understand what you're looking at. This is a limit order book. Every exchange runs on one. The left side is the bid, patient buyers waiting at their price. The right side is the ask, sellers waiting to be filled. Each row is a price level. The numbers on the left are quantity, how many Bitcoin are available at that exact price. The market price, the number on CoinGecko or your portfolio, is the midpoint between the highest bid and the lowest ask. The gap between them is the spread. On Binance BTC USDT right now, 1 cent, 1 tick, 0.013 basis points, among the tightest spreads in any financial market globally. So, where does the $13 go? When you place a market order, you're saying, fill me right now, whatever the price. Your order hits the ask side and starts consuming it. The order arrow enters from the right and begins consuming ask levels. Level 1 fills 187 Bitcoin at 74,500.01. Level 2 fills 3.24 Bitcoin at 70,500.02 and continues into the third level, each fill at a slightly higher price than the last. Your expected entry was the mid price, 74,500.005. Your actual execution averaged slightly above the ask. The half spread cost, $1. You pay it every single time you place a market order. The spread exists because market makers face three distinct costs. Understanding them explains everything else in this video. First, order processing, the cost of running the matching engine. In a market as liquid as Binance BTC USDT, this is essentially zero. Second, inventory risk. When a market maker sells Bitcoin to you, they're now short. If price rises immediately, they lost money. The spread compensates them for carrying that risk. Third, and this is where things get interesting, adverse selection. 10% of the spread on average in crypto markets. This is the cost of potentially trading against someone who knows something you don't. We will come back to adverse selection. It is the most interesting and the most insidious of the three. This is the square root law of market impact, empirically confirmed across every major asset class, including Bitcoin, where Y is approximately 1, confirmed empirically. Sigma is Bitcoin's daily volatility, currently around 3%. Q is your order size. V is the average daily volume, $2 billion for BTC USDT on Binance. Here is the impact across 5 order sizes, plotted on a log scale. The actual impact is the gold curve, concave, following the square root. The dotted line shows what linear scaling would look like. Reality is far more forgiving at small sizes. A $100 order, impact is essentially zero, negligible. A $1,000 order, 7 cents, still essentially nothing. $10,000, $2.12. Our trade, the square root law just cost you more than the spread did. $100,000, $21 of impact. Now you start caring about execution quality. $1 million, $670 in price impact alone. This is why institutions employ entire teams of execution specialists. The key insight: double your order size. Impact increases by the square root of 2, 1.4 times, not 2 times. This is why slicing orders works. For our $10,000 trade, $2.12 in price impact, added to the tracker. Meet 3 actors in every trade: the uninformed trader, that's you; the market maker, the entity providing the bid and ask; and the informed trader, the one the market maker is afraid of. When your order arrives, the market maker faces a binary decision. Is this an uninformed trade, someone who just wants liquidity? Or is this an informed trader who knows something I don't? They cannot tell. The spread is their insurance premium against being wrong. Albert Kyle formalized this in 1985. Price changes are proportional to Kyle lambda, the order flow imbalance. High lambda means a thin, sensitive market. Low lambda means deep liquidity. VPIN tracks order flow toxicity in real time. Low values mean normal, unthreatening order flow. Watch what happens when an informed event enters the market. VPIN spikes past 0.65, the threshold. Market makers immediately widen their spreads or step back entirely. A 2025 study confirmed elevated VPIN significantly predicts Bitcoin price jumps and correlates with their magnitude. Then it subsides as the informed order is absorbed and the market reprices. The adverse selection component of your $10,000 trade, 21 cents, 10% of the half spread, confirmed by empirical literature on crypto markets, added to the tracker. 4 components, each one adding to the true cost. Total hidden cost above the stated fee, $3.33. Total true cost to enter the trade, $13.33. Across 5 order sizes, the pattern is unmistakable. A $100 trade, 11 cents total hidden cost. The system doesn't extract from small retail. It can't. The numbers don't work. 1,000, $1.18, still negligible. 10,000, our trade, $3.33 above the fee. This is where most active retail traders operate. 100,000, $133 of hidden cost. Now execution quality matters significantly. $1 million, $1,837 in hidden costs. This is why institutions exist. Price impact, the third column from the right, is where the scaling diverges most dramatically from what traders expect. 5 things you now understand that most traders do not. Every market order pays the half spread. Price impact follows the square root law. Adverse selection is real, roughly 10% of the spread in crypto. VPIN predicts Bitcoin price jumps, and your $10,000 trade's true cost, $13, not the $10 fee your exchange shows you. The formula complete. Part 2 of this series, who collects the spread and how market makers use order flow information to predict short-term price moves with statistically significant accuracy. Series link in the description. This video is educational, not financial advice.